The previous question that we got, firstly, was what is your definition of a bubble? When do you think the bubble will burst, and how long will the reflation last? That was the first question.
Yeah. Okay. Shall I answer that one first?
Yes. Yes, please. So, yes.
There's no perfect definition of a bubble. I mean, often people talk about a 2 standard deviation rise in an asset class. And I think there are certainly some assets out there that you would say look pretty bubbly at the moment. And why that's an important question is often people say, you know, is the Fed going to push back if it sees a bubble? And the Fed's answer to that has always been, you know, we don't know what a bubble is. It's very hard for us to say this is definitely a bubble. And, you know, I showed you in the slides that the valuation for US equities looks quite expensive, but not relative to bonds. So is that a bubble? You know, I think you can certainly say that Tesla's share price is a bubble. GameStop share price is a bubble. Probably Bitcoin is a bubble. But what I think I would say at the moment, there's no generalized bubble out there. That there are parts of the stock market that still look quite cheap. Parts of emerging markets look quite cheap. You know, I showed you the value stocks look cheap. The banking stocks look cheap. So, and I've also showed you there's still a lot of cash sitting on the sidelines. So, you know, it's a little bit like there are certain small bubbles. So think of the top of a glass of beer, but there's no one big bubble yet. So I think one way to think about it is that the Fed was getting a bit worried about this. They have clearly not pushed back in the last 2 or 3 weeks against the rise in interest rates. Powell gave an interview to the Wall Street Journal last week, and they asked him time and time again, aren't you worried about interest rates? Are you going to do anything about it? And he avoided the question. I think the Fed's actually quite pleased. You know, we've had a 30% decline in Tesla stock. The Fed thought that there were some bubbles forming, and with interest rates rising as they have, that has taken the air out of some of those small bubbles before they became one big bubble. So, you know, the question on the reflation trade, therefore, you remember that framework that I showed you that, you know, typically expansions continue until the output gap turns positive. You know, that will then be either the Fed needs to raise rates to kill inflation, probably it will not do that. And therefore the inflation comes not in consumer prices, but in asset prices. So I think it's quite possible in a year's time, we will see a reflationary asset bubble. But I think at the moment, I wouldn't say that's anywhere close to the situation that we have.
All right, thank you for that. The next question that we had was, what is your outlook on alternative assets?
So it's a very wide range of things you'd include in alternative assets. I would probably reword that to say illiquid assets. So a lot of them, private equity, hedge funds, real estate, the characteristic they have in common is you can't buy and sell them day to day. You know, if you have an investment in a hedge fund, you're often locked in for years at a time. Same if you buy a building in commercial real estate. So what you there are getting is an illiquidity premium. And what you have to understand is, are you an investor who can take that illiquidity premium? So if you are, for example, a pension fund and you have a 15 to 20 year time horizon, and you clearly therefore can take that illiquidity risk, you would be actually stupid not to use it. So you should, and historically, for example, if you take private equity versus public listed equities, private equity has returned maybe 4 or 5% more than public equity. So you're getting nicely rewarded for taking that illiquidity risk. But for many people, you have to really consider whether you can afford to be locked up for that long. So I think that's one way to look at it. So that certainly would make sense. Within the alternative asset classes, my preference at the moment would be for private equity and distressed debt. The reason for that is they have historically done well early in the cycle. So there are still quite a lot of weak opportunities out there. If you think about the retailing sector or the hospitality sector, hotels, airlines, restaurant chains, they've been really badly damaged during the pandemic. Many of them will go bankrupt. But for a smart private equity fund manager or distressed debt fund manager, there should be some very interesting opportunities to buy companies that are going bankrupt, where you can buy them very, very cheaply, but you can identify they still have some brand value, they're still a going concern. And when the world goes back to normal, these are companies that make profits again. I would be careful on real estate. And I think that the world after COVID-19 will be one where we work much less 5 days a week out of an office, I mean, culturally, it may be different in different countries. I mean, maybe Korea, there's perhaps a bit more of an incentive to all go into the office. But I think in North America and Europe, yeah, people like myself will go into an office 1 day a week, a couple of days a month, which means that big companies won't need expensive buildings in downtown Manhattan and City of London. And therefore, people won't need to live within 30, 40 minutes commute of those offices. And most real estate in the alternative asset area is concentrated on commercial real estate or large apartment buildings in major cities. That to me seems like quite a risky asset class at the moment.
Very understandable. Thank you very much for that. The next question is, do you think of CBDC, central bank digital currency, as an alternative asset? Could it be considered a promising digital asset in the future?
So, at the minute, obviously, none of those exist. No central bank, as I can think of, has actually launched one. I think the Chinese may have an experimental program, if I remember rightly. I'm sure they are all looking at it. We know the Fed is. And ultimately, the difficult question they have is that if you have a central bank digital currency, basically means we all have to have an account with the central bank. And if you have that, why would you have an account with any other type of bank? So, if let's take a Canadian example, I live in Canada. If the Bank of Canada, our central bank, suddenly had a digital currency, and I have something on my phone that lets me use Canadian dollars, why wouldn't I just put all my deposits into the Bank of Canada rather than using Royal Bank of Canada or Toronto Dominion or the commercial banks? So I think that's an issue. But as I said in my presentation, I find it hard to see that the private cryptocurrencies will do well. And a couple of other points I would make is, Bitcoin is limited to 21 million units. It's already at about 18.5 million. So what happens when it hits 21? It's going to be massively deflationary. You don't, in the same, much worse than the gold standard was. And people like to say, well, the problem at the moment we have is central banks print money all the time. And the great thing about cryptocurrencies is that they are limited, 21 million Bitcoins. But there's no limit to the number of cryptocurrencies. So that argument really doesn't work. It might work for gold, but as we discovered in the 19th century, when we linked currencies to gold, that was massively deflationary. And in the 19th century, we had very frequent periods of negative inflation, of outright deflation. In a democratic society, that is just not acceptable, where people's wages go down very significantly. That just would not be acceptable these days. So it's hard to know exactly what happens, but I suspect there will be a lot of blockchain in future. The sort of things that Ethereum is doing with having smart contracts, where payment is automatically coming out of a blockchain. But I still think ultimately currencies will be backed by the full faith of governments. I just don't see that you can have a private currency in that way. And private currency is nothing new. In the US or the UK in the 19th century, every commercial bank printed their own currency. The fact that we developed beyond that means that there was a reason why that didn't work very well.
Thanks for that. I'll just go on to the next question. There is a growing demand for thematic investments such as cloud computing, biotech, clean energy, electric vehicles. Can you share your macro fundamental insight on these themes? As some of these sectors are closely related to structural shift from the fossil fuel to clean energy, it seems like the auto industry for cars with internal combustion engines will be in a structural bear market going forward. In the end, what and where do we have to monitor this trend? Perhaps China again?
So that's a very long, very big subject. In fact, I teach something called the GAA Academy. We have a BCA Academy, and there's a 8-session course I teach on that. And one whole hour of that is dedicated to exactly this subject of how to spot themes. But I'll try and answer it in 2 or 3 minutes. I do think that there are a lot of interesting technological achievements, technical developments happening at the moment. And if you look at the history of technology, it's something that really interests me. There have been 5 waves of technology since the Industrial Revolution. So there was steam, there were railroads, there were canals, and the current wave, and these waves typically have lasted 50 to 60 years. The current wave, information technology, started arguably in 1971, which was when Intel produced the first microprocessor. So what's interesting is we are now 50 years since that. And if you look at all the technology on the horizon, we've got a lot of things in bioengineering, biotechnology, cloud computing, robotics, AI, big data, automation. There's a lot of very interesting things going on out there. I'm sure you can think of more. So I think you could argue we're actually maybe at the very beginning of the sixth wave. This is not yet in the sort of academic literature, but it's quite possible to me. So I think it's certainly worth looking at this. And alternative energy is clearly one, self-driving cars clearly another one. What I would say though is it's very hard to spot the winners in these things. If you think about the internet, if in 1995 you'd have said internet's going to be the next big thing, I'm going to invest in that, would you have really invested in Google, Apple, Amazon, Tencent, Baidu? And most of them didn't exist. And you might have invested in things like Yahoo or MySpace or from all these things that disappeared. It's often easier actually to spot the losers. So I think you have to argue the losers are probably power utility companies. They may well be real estate companies. They could well be carbon energy producers. But that's, to me, is actually the way of thinking about it. Spotting the winners is hard. What I would say, though, it's another argument for liking things like private equity and venture capital, because those fund managers are paid to try to spot the winners. And they only get 1 out of 10, but that's all you need. So look for the losers and put your money in venture capital.
And one last question from this list is, if you're given a 5-year investment horizon, how would you construct your financial investment portfolio personally?
So I think I didn't talk much about valuation today, because our view, and my personal view, has always been valuation doesn't matter much in the short term. It's not a good timing tool. In 1999, when stocks were very expensive, they went on being expensive for 2 or 3 years before the bubble burst. But valuation is very powerful as a driver at 5 years or beyond. So if you're investing now and not going to touch anything, you want to be thinking about what is cheap. And so that clearly has to mean equities over bonds. If you're thinking again, US 10-year bond, well, the yield on 10-year US trips is currently minus 50 basis points. Why would you buy that? You're locking in a guaranteed loss. Equities look expensive, but you've at least got potential upside there. It certainly in that case would be on the 5-year time horizon an argument for buying emerging markets, not because of growth, because they're cheap. Probably having a preference for Europe over the US, and also on that time horizon, probably having a preference for value stocks over growth stocks. So I would probably be looking in that case at things like capital goods producers, maybe commodity producers, those sort of cheap stocks. So, certainly in the longer run, what you need to look at is valuation.
One audience asked, what do you think about Korean won and yuan?
Yeah. So let me start with the yuan, because I think the Korean won is pretty closely correlated to that.
Yeah.
And the yuan has obviously appreciated a lot in the last 10 months or so. Mostly that has really been a US dollar weakness story. So the US dollar has weakened against almost all of the major currencies. A few emerging market currencies are different, but against the developed market currencies. So as things stand today, probably the yuan has further upside, but not at the pace that it's been appreciating in the last 10 months. And that partly comes down to interest rate differentials. I mean, you think at the end of last year, 10-year Chinese government bonds yielded 3.5%, and US 10-year bonds yielded 0.9%. And I talked to a lot of conservative institutional investors who are saying, well, we're going to have to start buying Chinese government bonds. That the renminbi in the long run has probably got further to appreciate, and that interest rate differential is just too attractive. Now it's come down. The Chinese are about 3 and the US is 1.5. The differential has closed. Partly the argument comes down to trade talks, something we haven't really heard much about from the Biden administration. And the Chinese government has obviously a lot of room to manipulate the renminbi. I think they've been trying at the moment to play good boys and not to allow a depreciation. But if there are talks and Biden refuses to cut tariffs and starts to talk tough about genocide in Xinjiang or whatever, then that's a possible time when the Chinese might say, okay, look, see what we can do with the currency. So for now, I think the most likely scenario is moderate further appreciation of the yuan, but that's really more because the dollar will be weakening. So I would expect, therefore, to see the Korean won in the next 12 months, to also appreciate moderately, but not excessively against the US dollar. But really what it comes down to is a dollar weakness story rather than specifics for other countries. So I would expect to see the most appreciation of currencies like the euro, the Aussie dollar, the Norwegian krona, the more high beta cyclical currencies. Renminbi and the won probably not quite so much.
Thank you for that. The next question is, what would be the target of US 10-year bond yield at the end of this year?
So BCA typically doesn't make spot forecasts. So, we don't have a forecast for GDP growth. What we try to think about is what's likely to occur relative to what the consensus thinks or what the market is pricing in. So as I argued in my presentation, I think it's hard to see more than, say, another 30 basis points upside for the 10-year from here. So unless the inflation really gets out of hand and those break-evens go well above that equilibrium level I showed you, or unless the Fed signals that it's going to raise rates more quickly than the market is pricing in other words, more sooner than Q4 next year. So I don't think those things are very likely. So yeah, if I had to put a number on it, I would probably say 1.8 or something like that. I would be surprised to see it going over 2, I think, before the end of this year.
Thank you for that. The next question is, do you think that ESG investing is somewhat overrated at the moment?
So I think it depends what you mean by ESG. Almost every investor around the world, I'm sure in Korea as well, is now saying we are ESG compliant and we've signed up to the principles for responsible investment. And, we look at companies very closely and we appointed a head of ESG. And clearly there's still what it's like in Korea, but many countries I go to, the end investors are putting more and more pressure on institutions to think about ESG. Particularly, what's notable I've seen is that 3 or 4 years ago, Scandinavia, Canada, there was lots of interest. And in the US, nobody even knew what ESG meant. In the last year or so, even US clients are now asking more and more about ESG. So from that point of view, I think it's probably got further to go. The work that we've done has showed that you don't underperform if you have a portfolio with an ESG tilt, probably slightly outperform, not a big deal in it. So for a lot of investors, one of the places that's been obvious is with the university endowments, where the student body, which is obviously typically quite left-wing and socially conscious, and the academic body has put a lot of pressure on endowments to get rid of their energy investments to be ESG compliant. When you think about it, however, ESG means companies that don't pollute the environment. The S, social, means that they treat their workers well, and G means that they have corporate governance. I'm not sure I wouldn't prefer also to invest in companies that don't pollute, treat their workers well, and have good corporate governance. So, particularly in something like emerging markets, where those are often important questions, having a bias towards ESG to me does make a lot of sense. And I think one last point I'd make is that for now, it's a reason to be a bit concerned on the energy sector. I think we are seeing massive disinvestment from energy investments. You can see the way that energy stocks have not moved in line with the crude oil price recently. Eventually, however, it might be like tobacco was in the 1990s, when everyone had disinvested from tobacco. And there was a period when tobacco stocks did tremendously well, because ultimately it's an addictive product. Everyone needs to buy it. Those companies were very cheap. I don't think we've got to that point on energy yet, but there may be at some point where we do. We still need oil. There's no getting away from it for the next 20 or 30 years at least.
Very interesting. Thank you very much for that. The next question, we have another question from Jin. I know that there is a view of worrying about US deficit, which arise concerns about a stability of US dollar as a reserve currency. Do you believe the stability of USD as a reserve currency going forward? If not, any alternatives?
So I'd probably divide that into 2. So I think it's not impossible that you might see a pretty sharp decline in the US dollar. If you had a situation where the US was keeping bond yields down, let's suppose in a year or two's time, inflation has really picked up. The Fed has said, we're worried about how much public debt there is. If interest rates rise, government borrowing costs are going to go up. So we're going to ignore the inflation. You could certainly imagine that environment, the dollar weakening quite sharply. And then 50% of the treasury market is owned by foreigners. If you start to have a bond market strike, and foreigners say, well, why should we buy treasury bonds anymore? You know, they still don't yield enough, and there's a risk of the dollar going down. You know, a close to disorderly depreciation of the dollar, you know, is not impossible. But in terms of the US losing its stability as a reserve currency, so the question, which the question answered is, so what's the alternative?
Right.
The renminbi, the yuan, I mean, China's got a closed capital account. The PBOC is not an independent central bank. You know, in fact, in places like Hong Kong, the usage of the yuan has actually been going down in the last 10 years or so. China's the renminbi is a tiny proportion of global trade. The euro still, I think, has some existential questions about it. You know, if we go through another debt crisis, you know, this last crisis, the European institutions have functioned relatively well, but we haven't really solved the problem of Greece or Italy or others yet. So what else is there? Bitcoin? I mean, at some point, maybe there is an alternative. If you go back to the Bretton Woods negotiations in 1945, what Keynes proposed was that we would, rather than have the dollar linked to gold, that we'd have a currency, that's what eventually became the SDR, that would be linked to a basket of commodities. So I don't know, maybe you could envisage some IMF created cryptocurrency backed by the IMF and all the other large economies, that was somehow the amount of it was linked to the amount of certain commodities that were produced every. I mean, it's not impossible, but it took something like 50 years for the British pound to give way to the US dollar as a reserve currency. And still the US on most measures is the largest economy in the world. It seems to me we're at least 20 or 30 years away from having to think about a new reserve currency.
Thank you for that. We have two more questions, so we'll just finish off those two questions.
Yep.
How do you evaluate IG credit? As you mentioned, you prefer HY and EM sovereign. I'd wish to know what's the background you less prefer IGs. If you could compare US IG and Europe IG, that would be much appreciated.
Yeah, so it's a fairly simple story that the spread now on both European and US IG is very close to record low levels. So you're not getting much by way of spread pickup. So I have a neutral on IG, but it doesn't seem to me particularly attractive, and that spread has really come down. I mean, I suppose what you can say is that the spread currently is about 90 basis points for both US and European IG. So if you take the US 90 basis points over 150, the risk-free rate,
Right.
You know, maybe looks more attractive than 90 basis points over 350, which is what it was 5 years ago. But nonetheless, the spread pickup is just not good enough. You do start to see the double Bs, which is the high end of high yield, where there's still relatively little default risk. That the spread there still has, it's by no means wide, the spread, but it still has somewhat further to come down towards its previous historic low levels. When you go further down the junk bond credit curve, the problem there is that the market, we think, is not pricing in enough by way of defaults. And we really had very few bankruptcies last year, which, given how big a hit the economy took, is a little surprising. And the reason was that central banks and governments supported companies, but they gave them liquidity. Often, indeed, they gave them extra debt to keep them going during the bad times. But are they really able to survive for another quarter or two? Some of those companies, I think, will just give up and declare for bankruptcy. So I would see the default rate. Currently, the implied default rate in US junk bonds is only 3%. The historical average is 4.5%. Last year, it was 9%. So that, to me, is much too optimistic. So I'd be a little bit careful there. And between US and European IG, there's not really much to choose from at the moment. They both look, similarly rather unattractive.
All right, thank you for that. Last question. I understand, this is the second question from Mr. Lee. I understand the key indicator would be PCE inflator to review asset allocation strategies, and market consensus is around below 2% in 2021. Is there any historical example of quick rise unlike the market expectation? If yes, under which market condition?
Yeah, so I mean, remember, so the key is certainly looking at inflation, but there are some things to remember about it. So first of all, the Fed has said, I showed you the table, that they want to see inflation significantly, or they want to see inflation moderately exceed 2% for a certain period of time. So the Fed is worried that, I showed you the chart earlier, that since they introduced their target of 2% PCE inflation, on a 12-month moving average basis, which is what they say they look at, PCE inflation has never been above 2%, and it's supposed to be an average of 2%. So in order for it to average, and when they announced this new framework last August, they re-emphasized that word average. For it to average 2%, it's got to be above 2% for some time. So 2% isn't really the line. It's probably more like 2.5 or 2.8. And it would need to be, looking as far as the Fed was concerned, that's going to go significantly further than that for a while as well. So, when it goes to 2.3, 2.5, that's not really the issue. It would need to be showing signs of going to, say, 3 or 3.5. I remember I showed you that 3.3 that was the tipping point for when equities did well or poorly. I think the historical examples, we've written quite a lot about the 60s and 70s. And what happened there was that in the 60s, inflation was gradually rising slowly, and then it spiked. So very often it's a non-linear relationship. And often people think about the inflation we had in 1973 onward as being caused by the oil crisis, the oil shock. But actually that was just the immediate trigger. The underlying reason was more that the Fed had quite clearly had policy that was too easy in the 1960s. And there was Arthur Burns, who was the Fed chair in the late 60s and early 70s, was an old friend of Richard Nixon's. Nixon, we'll know from the history now, quite clearly bullied him into not raising rates. And there are clearly some parallels with the current world, where I'm not saying that the president, maybe Trump might have been, but the Fed potentially is keeping policy too easy. So that's probably the best comparison, is that inflation can sneak up on you. It can gradually pick up until suddenly, in a few months, it's going at a really uncomfortable level, and which the Fed would then, therefore, presumably, because it knows now how dangerous and how damaging the 1970s were, the Fed knows how to deal with inflation, but it would have to create a recession, essentially, to stamp down on that inflation that picked up.
Right. Well, thank you very much for that. That was very informative. We've practically answered all the questions, except we did get 2 more questions, but I think Minu will be able to help.
I'll follow up in the email that you provided, or else you can also come to a BCA research website, and then if you can drop us an email address there, I'll be able to reach you out.
All right, thank you very much for your presentation today. It was very informative and very practical for us. Very, very helpful at the current market condition. So
thank you for inviting me. It was my pleasure.
Yeah, I look forward to talking with you again in the future. Yeah. Thank you very much, Minu.
Thank you very much.
Thank you. Thank you, everyone. Thank you, everyone.